Welcome to the best prop for you trading floor. And today we've got an interesting setup developing on gold. We are sitting right at a pivot point where the market is about to make a critical decision. I think, to be honest, the decision has already been made. And if you're trading a prop challenge, this is exactly the kind of environment where patience and precision separate funded traders from failed accounts. So gold printed a new high recently, just close to the 5,100 per ounce dollars. But here's a problem: the money flow index didn't follow. We've got a classic bearish divergence sitting right in front of us, and now the Bollinger Bands are flattening out, which signals that volatility is collapsing. Let me walk you through what's happening and, more importantly, the two trade setups we are watching. Actually, the one is playing out as we are recording this video. First, let's talk about what the chart is telling us. Okay, so the divergence, the price pushed from the 5k up to 5,100. But look at the money flow index down here. It stays flat around 80, overextended indeed, and never confirms that move. That's considered a bearish divergence. It means that while prices was climbing, the actual buying pressure, the flow was drying up. The money flow indicator is quite important in commodities. That is a red flag, and that the upside momentum is weak. Now, notice the Bollinger Bands. They are the 25 period and 2 standard deviations. They've widened dramatically during the recent volatility, but look at the right side of the chart. They are starting to flatten, not tighten as much, and currently that gold is retesting that low. You see that it's actually leaning to the downside. So our upper band is around the 5,130 level, 35, and our bottom lower band is currently at around the $4,880. The question now is, will support hold or will it crack? So here there is two trade setups, right? So which one you take really depends on your risk tolerance and the challenge rules and where you are in terms of those challenge rules. So the high risk play is the aggressive play, I would say, for traders who want to ride the current bearish momentum. We are still trading during the London-New York overlap, nylon, and volatility and liquidity still remain high, but London is closing in a few hours. So what is the trigger in this particular case? Because bias remains to the short side, to be fair. We've also got a very important psychological level at 5k that we've actually broken lower from. So the idea is a break and close below the current consolidation zone. Specifically, we're looking at the 1 hour chart candle closing below 4,875 with conviction. Our previous 1 hour candle had conviction. This one shows that volume also increasing. We do not know whether that volume is bullish or bearish, but it looks like at this point that is mainly bearish. Now, if we see a break of that level, we could see an acceleration lower. And, there isn't much more downside to make apart from going down to 4,800, which is a previous swing resistance, which would essentially turn into support, perhaps. So you go looking at $100 range. The stop loss would have, of course, to be tight. Okay, you wouldn't want to risk anything more than $50 move to the upside in this particular case, because currently with volatility seemingly kind of consolidating, let's say, there is a high chance of a potential Bollinger Band bounce. So this first setup is a continuation trade in a market that is already shown massive volatility. But if you're already down for the day or week, I would skip this trade. The bounce are flattening, which means a violent reversal could happen at any moment. You could easily get stopped out if the market decides to bounce. Okay. And what is the second consecutive long play? The bounce. This is more of a high probability play for me and a lower risk setup. If you could, of course, assume that trading is low risk, it's not. It always involves higher risk. But it is my preference for challenge accounts. The buyers might be looking downwards, but wait and see. Let the market prove itself first. Price dropped to 4,880 and volume spiked. Now, the money flow index didn't really go to oversold levels, but there is some sort of divergence on the 1 hour from the previous trough. The entry would be right at the rejection of the bottom, an aggressive entry, okay, with of course a second opportunity to trade the bounce after the hourly close. Now note that that close won't necessarily mean the price is not going to come down here, right? And one might see a second retest, a double bottom that would of course increase the chances of seeing a bounce all the way to the upper band. The first target, of course, will be the 5K. Yeah. And then all the way to the upper band. But essentially, I will start taking profits at the 5K and then higher up at 5,090, which is the previous peak. And then trail that stop for the rest of the distance, which isn't too large, to ensure that you are going to secure those profits in. The stop loss would be just below the 4,877. We could essentially just assume that the $30 range would work okay. Why is this a better trade? Well, you're buying at a defined support level with confirmation. You're not chasing a falling market. You have a clear invalidation point and you're also trading with the Bollinger Band reversion, not against it. This is already seen a squeeze to the upside. Now, here's the reality. Both of these setups can work. However, one of them should be in your plan, depending on where you are in your challenge. If you're trading with best prop for you, here's your checklist. Position size. Calculate your loss size so that your stop is hit. You lose no more than 1% of your account. Gold moves $20, $30, $40 in minutes these days. Respect that. Daily drawdown. If you're already down to 3% today, do not take setup 1. Wait for setup 2 or wait for tomorrow. The market will still be there. No revenge training. If you get stopped out on the short, do not flip and immediately go long. Let the market prove the bounce first. Emotional trading is how you blow challenges. And we don't know, of course, if the 4,900 will hold. We don't know if it will break lower. That's why we wait for the market to show us with price action and volume before we commit capital. The goal is not to catch up every move. The goal is to pass the challenge, get funded and trade another day. So to recap, we are watching for a retest that actually happened live of the 4,900 support as we expected, based on the bearish divergence and weakening money flow. If you're aggressive and your account can handle it, the short is kind of live, but maybe even dead for now. But you need to also use a tight stop. If you're being smart with your challenge, wait for the bounce confirmation at 4,900, okay? And you could essentially trade the reversion back to at least the previous peak with a higher target at the previous, at the upper Bollinger Band. Mark your levels, they are already marked. Set your alerts and let the market come to you. This is best prop for you. Funding disciplined traders who respect the process. Good luck, and we will see you in the next prop. breakdown.